Bowl predictions while we're having people join live. Jim is our guest. I'll go to you first.
I don't know, man. Mahomes, man, I just think he's the future of quarterbacks. He seems to be getting better and better every game. It's hard to stop a guy that can do, run, pass, do anything with the football and make stuff up along the way. He's fun to watch. A lot of excitement to watch him. So I don't know. It'd be interesting, but I think the Chiefs are going to be hard to beat.
NFC, any prediction for their Super Bowl opponent?
I'm sorry?
The NFC, their opponent, a prediction? Throwing you right in the hot seat right out of the gate here. This was not scripted. This was
way off script here.
I don't even know if Jim's a football fan. I see Mike, Eagles.
Eagles, huh?
To me, it's, I love, the Bills story is obviously a great one. I think Cincy's winning and Cincy's going into Buffalo and winning there next week. I think it's a Cincy KC in a San Fran Philly Final Four. I'll go with the Niners over the Bengals is my official prediction. Rob, you got a prediction?
Well, I got to root for the 49ers. They're in contention, right?
Yeah, I just picked them to win it all, so I hope so, yeah.
Yeah, I think
Brock Purdy.
Yeah, who one day he's on a paper route, the next day he's quarterbacking an NFL team. It's really something.
Pretty cool story, isn't it?
Hey,
yeah, but I agree. The Bills are running a lot of emotion right now, so they sure were a firehouse last game. I mean, they were just on fire, so they can keep it going. It's kind of fun with playoffs, and everybody it's a whole different thing. People just pick it up and play a whole different level. It's pretty exciting.
Man, if Hamlin is in that stadium this Sunday, or even on the Jumbotron, the Dolphins without Tua, oh my, you talk about being fed to the wolves.
Yeah.
There might not be nothing left of that team 3 hours later. It should be interesting. So happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. As always, pleased to be joined by my esteemed colleague and co-host, Rob Chrisman. Rob, good to see you. Happy New Year.
Good to see you too. Excellent. Where am I?
Well, yeah, where are you? We always kind of start with that. You're very picturesque. That can't be Lake Tahoe.
No, I'm about 15 minutes north of Lake Tahoe in Truckee, California, which is about half hour, 40 minutes west of Reno, Nevada.
Awesome.
And yeah, definitely getting hit by storm after storm after storm. So thus the snow.
Yeah, there's a lot of it here in Cleveland as well. So, and our co-host this week, longtime partner at TMC, Maxwell, goes way back. I mean, when TMC was really smoke and mirrors and dreams and hopes. And I remember meeting Jim, your boss, John Passon, at a conference back in the early days. Just very, very impressed by him and his vision for the mortgage industry. So seeing it unfold this past half decade has been really, really rewarding to me. And, I guess started out as a POS, and now seeing you guys kind of go into fulfillment and QC, due diligence, establish a trading desk, bring it all together for lenders that are looking to do business with kind of less counterparties and good counterparties. I probably should introduce you too. You're their senior vice president of due diligence, Jim Smith of Maxwell. Jim, thanks for joining us.
Appreciate it. Thanks. Great to be here.
And there's all kinds of stuff I want to get your thoughts on. You got a really decorated background in the industry, some servicing stuff, and some other things I really want to dig into as we get into the show, some really relevant topics. And as always, for our attendees, always already see a lot, as always, of activity in the chat and the Q&A, mostly Super Bowl predictions at this point, but any legitimate or non-legitimate mortgage or non-mortgage questions, feel free to put them in the chat, in the Q&A, and we'll incorporate them in the show. Rob, you got your hand up already. Okay.
Can you define a non-legitimate mortgage question?
Many of the ones that come into the chat each week,
Okay, never mind. I get it.
I don't want to really get specific. Yeah. So, all right, Rob. So, last year, there's no way to polish that turd. Let's just move past it. And, this year, though, a really legitimately optimistic start to the year. We've now had 4 or 5 big economic numbers that came in better than expected as it relates to core inflation. Another one this week when we got the consumer price index right in line with economists' expectations of falling one tick from November to December. If you exclude food and energy, core CPI also looked at also right in line with estimates. And, you know, if you look at inflation just in this last quarter, it's still a little bit higher than healthy, but it's almost normal. And, you know, there's been a pickup. We've seen a little bit more relief in the bond market, pickup in all the different application indexes you see out there. Obviously not robust business, but by all accounts, a pretty optimistic start to the new year. Your thoughts?
I agree, but when you say optimistic
is you know, portending a better than expected year. So expectations today versus a month ago of 2023.
I remember when I was running secondary or capital markets for different companies, and some loan officer, some account executive would call in or shoot me an email and say, is the bond market going up or going down? And I'd have to say, do you mean prices or rates? And then they'd say rates, because then or prices or whatever. Then that would lead to a discussion about why, when prices are going up, rates are going down, and vice versa. So when you talk about the economy, when you talk about people hoping for lower rates, we can get lower rates through a couple of different methods now at this point. But in general, we've been hearing about a recession for since the Carter administration, and it just doesn't seem to be materializing. But if we were to get into a recession, of course, that would mean lower interest rates. And when you talk to the average person and ask them, do you want to see lower rates? Oh yeah. Do you want to see those lower rates caused by a recession? Oh no, of course not. Well, then what is going to cause rates to go down besides a recession? Well, in this case, to your point, and I think you're spot on, the employment numbers from last Friday and then the consumer price index numbers from this week are fantastic in terms of, the employment picture continues to be very strong, very unrecessionary, as a matter of fact. But yet it appears that 3 months of a downward trending inflation report is very, very good news for the Federal Reserve. And as we've talked about, whatever moves the Federal Reserve makes, like turning an aircraft carrier, takes a while. And it appears that the moves that have been made, attribute those to the Federal Reserve or somebody else, are having an impact. And so if we can get into, quote, the fabled soft landing, which is the Federal Reserve goes just high enough in terms of short-term interest rates to cause a slowdown in the economy, but not a recession, and get into a soft landing, I think, once again, to your point, I think that is very good news. And it's been interesting to me because we have so many people on the phone who are in effect running their own small businesses, and they're dealing with borrowers every day, or underwriters, or managing teams, but they're also dealing with the US economy or the world economy and what's going on with the consumer price index and so forth and so on. And the big news, of course, this week, and I'm sure you're going to get to it, is the Wells Fargo news. And so we're looking at the employment data, and we're looking at the consumer price index data. And next week it'll be something else, and next week it'll be something else. And there's always economic news coming out. But today we were presented with this piece of hard information about Wells Fargo exiting correspondent, scaling back on retail. As you might recall, 10 or so years ago, Wells Fargo exited wholesale, basically because they couldn't guarantee to the CFPB and other government bodies that all the brokers were doing the things that brokers should be doing in a compliant manner. But that's a discussion for a different time. But with the news about Wells Fargo, for years and years and years, Wells Fargo was near the top in terms of servicing. And we're dealing with the CPI, and we're dealing with some good economic news out there, but we're also dealing with a lot of people who are about to lose their jobs. And people are going to be displaced and servicing is going to be displaced. And that feeds right into Jim's sweet spot, because Jim, I know that if you were riding down in an elevator and somebody said, Jim, what is an MSR? Or Jim, when I send my payment of $2,000 a month in to PHH, what happens to that money? You would have an answer. So when you saw that Wells Fargo news, your mind might have automatically gone to, gee, Des Moines servicing, the impact on the Des Moines economy if all the jobs go away. But that aside, what are you telling people? What are you hearing in terms of the value of servicing? Maybe you even want to take a step back. What is an MSR and how does the valuation take place?
Yeah, no, absolutely. So I mean, there's really two components of a mortgage. There's the whole loan, and there's the rights to service that loan, or mortgage servicing rights. They're both tradable assets. A lot of times when someone sells off a mortgage, they sell the rights, the MSR with the mortgage. A lot of people actually hold on to the MSR and put it on the balance sheet. And like I said, it's a very tradable asset, and it's a very, very active market, especially right now. Really, the valuation of that MSR strip or MSR piece of the loan is really around the duration of how long that person is going to stay in that house and get that cash flow. So you're getting paid every single month for servicing that loan. So as long as that person stays in that house, doesn't refinance or sell the home, there's value to that asset. So if somebody got into an interest rate, say 3-4% when rates were low, rates are no higher, of course, now, probably not a good chance for them refinancing or getting out of that mortgage because it's a higher interest rate environment. So the value of that MSR holding goes up because there's really nowhere for that person to go. Now, conversely, when the rates go down, start dropping a little bit, somebody has a higher interest rate loan, there's some incentive for them to potentially refinance, and there could be some drops in the MSR value. So again, if you want a bunch of cash and you think the value, is kind of peak where it's at right now, and you think the rates aren't going to drop too much lower, could be a very, very good time to sell MSR holdings. And that's what we're seeing. I mean, I think we're all talking about Wells Fargo. There's a bunch of issuances going on in the MSR world. Here at Maxwell, we actually do due diligence on MSRs, on trades. And we're hearing a lot more clients going to market once a quarter, but I think it's going to pick up a little bit more too. Be interesting to see where rates go. If rates continue to drop a little bit more, some of those values might drop a little bit too, just because again you're going to have some refi activity going down, and you're going to get some maybe some diminished value a little bit on some of the MSR strips.
And Jim, so real quick, I mean, there's been a lot of activity in the MSR space as of late. Is that because people that hold servicing are starting to see the economy doing better, feel like rates could be lower than most are expecting, and they're like, okay, hey, it's time to sell this servicing before it all pays off if 30-year fixed rates get like into the 3s and the 4s? Is that basic mentality why we're seeing a lot of activity right now?
Yeah, I think there's a lot of smart people obviously kind of taking a look at the market, have a good eye on where they think rates are going to go. And absolutely, if you're sitting on a large MSR holding and you think that refinances are going to pick up a little bit, your value of your portfolio is going to start dropping a little bit. Because again, it's all about duration. It's all about having that person stay in that home, not go anywhere. And if they're going to refinance out, they're gone. So yeah, I think there's probably going to be a little bit more activity if people think the market's going to actually improve a little bit. It's going to pick up some MSR holdings or MSR sales just because people are trying to get out of their position a little bit. And it's great cash.
Rich, you could also argue that when you look at valuing a company, and I talked to the M&A guys at Stratmore quite a bit, but the value of a mortgage company, oftentimes the first question is, well, do you have any servicing, or do you not? Do you sell your loan servicing release? If you have no servicing, the value of a lender is impacted, shall we say. And to Jim's point, the value there goes up and down with interest rates and interest rate projections, and if you think interest rates are going to move one way or the other. But the fact of the matter is, a lot of companies now need the money. And so regardless of if we've got Jim and Rob's mortgage and we've got $1 billion of servicing, and we think rates are going to go up more and our servicing is going to become more valuable, but darn, we need to meet payroll in February. I'm going to be on the phone selling all or part of that servicing just because I need the money. So it's nice to think about projections, and obviously they impact the value of servicing, but many companies out there and talking to people who are involved in servicing sales, it's because the companies need the money.
Yeah.
Kate was chatting there. I think Kate said the same thing you just said, Rob. Yeah, I mean, there's huge operational losses right now, and you got this big piggy bank sitting in the background. So breaking that piggy bank and getting some of that money out, covering some of those operational losses makes a ton of sense.
So Jim,
I'm sorry. Go
ahead. Jim, if you're, earlier I mentioned, you're riding down with somebody in an elevator and they ask about MSRs. What do you tell people that Maxwell does? What's your one paragraph? You meet somebody at a bar, at a conference or whatever, and they say, where do you work? And you say Maxwell, and they say, what's that?
Yeah.
What is your answer?
Yeah. So Maxwell, we start off as a technology company. So we know as we mentioned before, they're start off at the point of sale, set technology solutions, win fulfillment. Again, I run the QC and the due diligence, so we do a lot of rated deals. But really, what we do within the MSR space is, we're an independent third party to go in to make sure that the asset, the MSR asset, the borrower, take another look at the borrower, making sure that the credit profile, the servicing activity was sound on that borrower, because obviously you're trading an asset based off, say it's you, Rob. Making sure that you're a good credit risk, that you've been serviced well. And we also take a look at compliance too, to make sure your loan is closed in a compliant manner. No one wants to buy any kind of asset that's not compliant. So we do a complete compliance check as well. We look at the property, do an occupancy check, make sure someone's in the property, it's in good condition, that type of thing as well. Because again, that all drives to someone staying in the home. So we do that independently. And so when somebody's going to sell, we see clients doing a proactive approach too. Kind of speeds up the velocity of a transaction. So say, Rob, you have a large portfolio of MSRs you want to go to market with. Engaging us up front, we'll go ahead and do the diligence on the pool, give those findings. If there's any problems or so forth, you can drop those assets out of the pool. Then you can go to market with basically our findings reports, and you can bid appropriately and close on those MSR transactions very, very quickly. So we're kind of an auditor. We're kind of independent auditor, unbiased in the transaction.
All right.
I don't know if that'd be a long elevator trip. That'd be like a 29-floor elevator trip.
No, that would be a third of a margarita speech. Bar.
Rob, as you noted, big news this week, Wells Fargo exiting the correspondent space. They noted a few months ago they were going to be seriously stepping back. Many wondered, is this the portender to maybe a exit, which we saw? And I want to get Jim's thoughts on how that could affect the MSR market in a moment, but just a quick thing on Wells. I mean, I did a ton of business with Wells and their cash desk over the years, and I just want to say, just what an operation, so professional. They were such a rock for this industry. It's sad for me because they just did things the right way, and just a real great company, a great correspondent lending operation. Good friend of the show, Chris Bennett from Vice Capital Markets. We have him on regularly to talk about the market. He sent me an email. He's traded probably billions of dollars with loans. I just thought it was a good kind of eulogy to Wells correspondent. I wanted to read it real quick. Hope he doesn't mind. I didn't ask for his permission, but it's very complimentary. From Chris Bennett, Vice Capital, real bummer for those that worked in Wells correspondent for so many years when others were losing their minds. Every time a crisis came around, Wells was one of the very few that would try to keep a level head and not just leave mortgage lenders holding the proverbial bag. It's very hard to make any money as a correspondent buyer. And it looks like they've decided there are so many attractive and less risky options in this environment at the bank, and they're not just interested, they're just not interested in the channel anymore. Fortunately, many other now seasoned players still are, and so the cycle goes. It's been a great run with those folks, that's for sure. They have a lot of the great veterans of the business. They've been there for the industry. A lot of times when no one else had the guts, the slow and steady stagecoach rides off over the hills into the sunset. Thought that was a great just summary of Wells. And Rob, I know you have a similar opinion, and I want to get Jim's thoughts on how this affects the MSR market, but It's a big loss for the mortgage industry because they were kind of like the adults in the room, is the way I viewed Wells Fargo correspondent for many, many years.
Yeah.
Rob, any
Well, no, I'll
thoughts?
turn it over to Jim
Yeah,
for
no,
his thoughts.
You're right. I mean, I think it really shocked everybody. I mean, Wells Fargo was obviously, talking about some of the largest lenders out there. Wells Fargo's always on the top of the list, right? I think on the servicing side, one of my former employees, it was a sub-servicer. They service a large book of Wells MSR as well as loans. And so I think in the impact, as far as servicing, transfer and disrupting borrowers, I don't think it's going to be huge. I mean, there's a lot of sub-servicers that have very large books of Wells loans. They'll probably not be too disruptive. Some of those sub-servicers are very big MSR purchasers as well. So I think probably some of them, they're probably working with Wells, probably being the top of the bidders and try to just go ahead and buy those loans. They're already servicing them today. So then they'll just own an MSR strip. So I don't think it's going to have too much of an impact on the MSR side, but obviously it's a feeding frenzy. There's going to be a lot of activity going on, a lot of money being transferred right now for the MSR. Again, it's going to generate a lot of cash for them. They have a massive holding. I think some of the street firms will probably get obviously very involved. There's some pretty large holdings out on the street. So we'll probably buy some of that up. And then I think just them exiting the space, a couple of lenders, it's going to be interesting to see them trying to grab market share.
Yeah, Wells Fargo, it's been the organization and the correspondent space has been excellent, and the personnel have been excellent. And so when you talk about what's going to happen now, you don't want to get into a situation where, like, right when the news actually broke, and I know we heard about the news last year, there was a news story about Wells taking a good look at correspondent, possibly getting out. This was actual news that happened this week. And the questions that I received right away were, is Chase next? Citi, we started selling to Citi Mortgage, or what are they going to do? So what happens, obviously, if you think about a situation, you think about a small town with 3 gas stations on 3 corners, and one of them decides to go out of business or goes out of business, leaving 2 gas stations. What impact does that have on the price of gas in that small town? Does it encourage collusion, price setting, and so on? Or, does the second gas station throw up their hands and say, we're done, leaving the 1 gas station? So when you have a player like Wells Fargo, whose market share arguably has been dropping over the last couple of years, taken up by the AmeriHomes, the PennyMacs, the other correspondent investors that are out there, Chase, Citi, US Bank, you can make a list, obviously. But with Wells' market share diminishing over the last few years, it won't have as big an impact as it might have a couple of years ago. Also, the market volume is down versus a couple of years ago. But it does signify something, and it does raise the question, now what? If you're an independent mortgage bank and still selling, a good part of your production to Wells Fargo every month because their system, their policies, their procedures, their guidelines, you like the rep, whatever it is, and now you have to find somebody else. Well, does AmeriHome really want your business? Does Citi really want your business? Or does Citi want your business at a certain price? And I'm not picking on Citi, I'm just using that as an example. What happens if a gas station goes out of business? Toys R Us goes out of business. What happens when you want to buy a toy now? Wells Fargo goes out of business. What happens when you want to sell a loan? Who do you sell it to? And do those companies really want your production? And what about net worth? What you have to learn all these new policies and procedures. I mean, it does really make a hole in the industry. And just like a non-QM player going out of business, as we saw last year, what now? What about the remaining parties? So it's not a particularly good sign. And it's easy to point to Wells Fargo and say, well, they had some major CFPB fines and so forth and so on. But it is a major loss to the mortgage business. And with regard to the servicing, the servicing, to Jim's point, I think it'll be fascinating to see what happens with that servicing. Not only that, But let's say mortgage rates go down. I know one of the questions in the chat room or the questions is, what if rates go to 5.5%? What's going to happen to prepayments? So you're dealing with all this servicing coming onto the market potentially. And if rates are sliding down, how are potential buyers going to value that situation? So Jim, once again, I'll turn it over to you. You've got a lot of things going on with the servicing business now. What are your thoughts?
So I think it's a great question. Someone asked about 5.5. Obviously it's just, when did that person go into the loan? Obviously, more recent originations at higher interest rate environments, obviously going down to 5.5 is going to be attractive because they're going to be in a higher interest rate. More seasoned loans when rates were lower, it would have to dip down pretty low before it's going to re-impact it dramatically. But it's the more recent book, I would say that's going to be an impact to the potential values because they're probably they're in a rate higher than 5.5 right now. So it just really depends on, and of course, larger originators have a pretty large book, obviously, right? Because they're originating lots of volume every single month. But yeah, the season stuff is probably pretty safe. The more recent activity will probably be subject to some pricing decrease.
Yeah, I guess to sum that up, if you don't mind me summing it up a little bit, if you look at all the trillions of dollars of mortgage servicing that's out there, given the rise in rates that we saw toward the latter half of 2022 and the volumes dropping off significantly, the number of loans as a percent of the overall servicing book that are in the sevens, probably relatively small. And those will be the ones, obviously, that refinance if rates go into the fives. But I think that's pretty small if you look at all the trillions that are out there outstanding.
Yeah. And think about too, servicing is all about numbers, right? To be a good servicer and make money at servicing, it's efficiencies with large amounts of loans. And so you have a lot of loans just falling off the back end of your portfolio every single month. So kind of refeeding that beast constantly, regardless of kind of where rates are at, is very, very important for servicers. So again, grabbing any MSRs they possibly can to increase that book of loans that they're servicing just makes them more profitable at what they do. So again, one of my previous employers was very aggressive in buying MSRs, extremely aggressive in buying MSRs, regardless of where rates are at, because they still have a large portfolio that's very, very seasoned from different interest rates environments, constantly falling off the back end.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman, and this week our co-host, the Senior Vice President of Diligence for Maxwell, Jim Smith. And Jim, Maxwell, your guys' platform, it is throughout the life cycle of the loan, from point of sale to quality throughout to execution on the back end. So you guys have a unique perspective on just volume trends in the industry. We've been hearing anecdotally from our members. It's been, again, you're coming from a low place, but pickups in refis, just, people that need to now that the year is over, kind of taking care of business refis, a little bit of percolations on the purchase side. Again, nothing robust, but a optimistic start to the year in terms of the volume side of things. You guys been seeing the same thing these last couple of weeks?
Yeah, we have, on our diligence side, we do a lot of home equity loans, do a lot of home equity close-in seconds. I've seen some more investors getting back in the DSCR space again as well. So that's kind of getting some new loan products. We also have what we call private label origination, where we take care, we're basically a mortgage company for you. So if there's a bank that wants to get in the mortgage space, it just doesn't want to necessarily have all the overhead and all the hassle of standing up a mortgage company, if you will, operations. We do it from point of sale all the way to funding. So we're getting a lot of activity in that space as well. And it might be new channels as well, or people traditionally may have had a mortgage operation that just don't want to have it anymore, but they still want to be in the space and offer it to their members if they're credit union or their borrower base. And so we'll take care of that from cradle grade. So yeah, we're actually picking up more and more volume, and we're seeing more and more people looking for efficiencies for obviously the operational costs, right? They did a lot of stuff in-house. Makes a lot more sense to outsource it. We don't use any offshore resources or employees. It's all onshore. A little bit different than us and other people. And we try to embed our technology solution in everything that we do, which is again a little different view of what we do compared to others, bring more efficiencies to the process.
And there is I have a question. I know that you were with another company and involved in specialized loan servicing. Is servicing, and I've always wondered this, so excuse my naivety, but is servicing a FHA loan different than servicing a VA loan, different than servicing a Fannie Mae or Freddie Mac loan, different than servicing a bond loan or an ARM loan or whatever? Are there a jumbo loan?
Not
Or is
really.
it all pretty much the same?
Yeah, no, I mean, it's relatively same. Obviously, reporting is a lot different. No, servicing advances are different, that type of thing. So no, the cost of servicing is different. But as far as your involvement with the borrowers, relatively the same. But definitely, servicing advances are different. Recapture periods are different. The involvement of some of the asset holders, their involvement in just day-to-day decisions is different. When I was with them, we had so many different investors that we're servicing for, and they all had different variations of how involved they want to be in servicing. But obviously, a borrower is a borrower is a borrower, trying to do what's your best you possibly can for every single borrower. But yeah, reporting and cost of servicing is different compared to one type of loan compared to the other.
It used to be that back in the old days when Tyrannosaurus Rexes roamed the earth, that the conversation would revolve around, well, you know what, when we think we can hit 100 million of servicing or $1 billion of servicing or whatever it is, then it starts to make financial sense. If we're up until then, it'll be it's going to cost us more money to service these loans than we're going to earn. Is that still a discussion topic about what makes sense to hold in terms of servicing? If you're a little company, is holding $10 million of servicing financially worthwhile? Or is there a minimum amount of let's say Fannie Mae, Freddie Mac servicing? Is there a minimum amount that makes sense for a lender who's actually increasing market share and seeing their volume do okay? Is there a minimum amount that they think, let's hire a sub servicer and let's get going with this?
That's a great question. We deal with a lot of credit unions, small to mid-tier banks and credit unions. For them, holding on to servicing themselves makes a ton of sense just because they want to maintain that relationship with their member. I mean, losing connectivity with that potential borrower in any way, shape, and form is death for them. So it's the lifeblood to maintain that relationship. So them maintaining their book of servicing is extremely important to them. You see other servicers out there that do kind of specialized assets, talk about home equity or HECM loans, those are reverse mortgages. You see servicers that kind of specialize in that. But then the mega servicers, talk about the SLS, the Dovin Mules, some of the larger servicers out there, for them, it's all about, as much volume as they can get their hands on. It's a massive machine. But then you have these kind of small regional servicers, again, want to maintain that relationship with their member or their consumer. And again, they'll never want to get rid of that. So really the volume is kind of irrelevant to them, is because they need to maintain that relationship to cross sell and make sure they maintain being a member in their credit union.
Now, I know you have to maintain your neutrality like Switzerland, but generally speaking, does a sub-servicer impact the value of the MSRs?
That's a good question. Yeah, I think it would, depending on how good at what they do. The servicing, not all servicers are the same. I think everybody would agree with that. There's some good sub-servicers and there's some not good sub-servicers out there. I have my opinion on which ones are good and which ones aren't great. But definitely good sub-servicers out there have a good reputation, that's doing their job well, servicing transfers well, maintain a good relationship. I think definitely would have an impact on the value of the MSRs as well. Absolutely.
Jim,
so do you have people at conferences trying to get you liquored up, pull you aside and say, Jim, I know you can't say this out loud, but who's a good sub-servicer?
Yeah, probably will be after this session.
Jim, what about, I've had some very smart people tell me that they feel that servicing in general is just overvalued because it's still valued the way it kind of used to be. I mean,
Rich, I just told you that last week.
Well, this was somebody else. Yeah. But that just a loan originator or a mortgage originator's ability to keep contact with a past client, not in, the collection of the money each month, is so much easier and better now that servicing inherently is overvalued. What say you to this unscripted, unplanned question?
I don't know. I mean, if you have your escrow analysis done wrong, or you're not getting your payments applied correctly, or can't get your servicer to work on, especially forbearance, extension, those type of things. If you don't do that well, it's really going to really impact your relationship with your consumer or your member. So yes, I agree. It's a much easier world to have contact with your member or your borrower. Just with, obviously with technology nowadays, but there's so many things as servicers involved day to day with just servicing a loan that can really take a relationship south in a hurry. Again, good servicers versus bad servicers. I've seen them both. No, we've had clients in the past that have actually pulled servicing from their servicer and moved it to a different servicer, and that's a big thing to happen. I mean, really, to say you're default on your servicing agreements and pull servicing is you have to mess up pretty bad. And we've seen that in the past just because, they're just really ruining the reputation of their brand, regardless of, if they have the ability to talk to their borrowers or not.
Rob, you're
Good
smirking.
times, bad times. No, I've seen my share. Rich, I'm going to
You're
interject
smirking.
here a little bit.
I know you got a point to make here. I thought maybe you were jealous of my newfound hair, but it's evidence the MSR point has you riled up here.
Yeah, it does have me riled up. When you talk about being overvalued, isn't the value of anything what a willing buyer and willing seller are willing to pay? Couldn't I say Nolan Ryan rookie card is overvalued?
Well, the people that were saying stocks were overvalued a year ago. I think people feel the same way about servicing right now. So,
yeah, I don't. There's Jim mentioned it earlier. There's so many external influences in servicing. It's a little bit esoteric. The average originator only kind of knows that it exists, but doesn't really get too involved in it. But for loan servicing, banks and credit unions, it's a great source of, a client base. Right.
A bank I worked for went under because of MSR misvalue. I'm not going to name any names, but they were evaluating 30-year fixed rate servicing at like 180 or 190 basis points for like 4 or 5 years. And this was about 20 years ago. But then the war turned and they had to sell the bank. So
yeah, what companies have it on their balance sheet is definitely a source of discussion out there. And if you're sticking out too far compared to other companies who own servicing, I think you kind of get mollywomped a little bit.
Nobody, and I hate to stay on this topic, but it's interesting, and nobody's falling off the attendance, which usually we get on these long servicing rants, but that means people are interested. Jim, explain the flip side of this to me. You got a lot of people that think it's a good time to sell servicing right now. We need cash, or we think interest rates are going to go down. The people on the other end that are buying this servicing, they know more than those people. What explain that dynamic to us?
Yeah, no, I mean, I think a lot of people were holding on to MSRs for a while, just kind of seeing where rates are. So I think I wouldn't say the MSR market had been dormant, but in a lower interest rate environment, it was pretty dormant. I mean, there wasn't a lot of MSRs being traded. So the fact that the market has kind of opened back up and there's MSRs available right now, I think it's a good time to buy, especially if you need MSRs and you want to build up your portfolio. Because who knows how long this will stick around? Because of course, rates are going to impact or dictate kind of the activity in the marketplace. So I think there's been some pent up demand on the purchase side, on the buy side as well, on the sell side. But I think there's been a pent up demand, and I think this is kind of the right market for people to kind of release some of those books. So.
And to your point, Jim, from earlier, I mean, like all these big public mortgage companies that otherwise would be showing massive quarterly losses, UWM and others, it's that servicing book and the markup on that is providing that's allowing them to operate not at a loss, at least most of them currently. So there's that hedge to it. And it's also what Rob brought up earlier too. Like, there's been a lot of M&A activity. A lot of people want to sell their company. And like, if you don't have servicing, if you don't need proprietary technology and you're an independent mortgage bank, like there's been a lot of people that have kind of gone down that road and like, well, what do you really have besides your good LOs, right? So that servicing is an asset. I'm painting the other side of the picture here and as you did as well. So
Yeah, no, again, I think the market's, and I think a lot of these MSR buyers right now, they're not they're not mortgage companies, they're portfolio holders, right? They have funds that are trying to invest, that are looking to add to their current book. That's what they're doing. And again, this is a huge opportunity for them, and a big one, especially when Wells Fargo's are dropping the numbers they're talking about right now, and others that, again, Wells Fargo is a massive whale out there. Once they sell off kind of their piece, who knows when that kind of allotment of MSRs will be in the market again. So kind of grab what you can.
Sorry about that. Somebody texted me that a bear walked behind me.
I've been in trouble many times. There's lots of bears.
I think that was just a hopeful viewer, maybe. Yeah. So
it could have been a dog. We call that a dog. You guys have bears.
Well, a bear is not something you want to see this time of year, needless to say, no. Especially around a house.
Jim, one other thing I wanted to get into with you, we have mail that comes in regularly to the show. I got a question this week that I wanted to just bring into the show. Just the question in general was about, getting back to a lower interest rate market. The fact we're not going to have the Fed in as a buyer, as they have been very aggressively through other low rate cycles. Like, how much does that, the Fed was a massive active MBS buyer for many years, helping, maneuver rates lower. In theory, not going to have that again in this year. So how does that impact things?
And the whole RMBS market, right? I think, this little bit of decreasing in the market, I think is going to help a ton. I think the securitization market has been relatively dormant, especially in this interest rate environment. A lot of our clients, I am seeing more and more securitization starting to happen again. Securitization collapses will be happening again, I think, with the rates kind of calming down. So I'm hopeful that we're going to see more MBS activity and more people coming back in the market and doing securitizations again with kind of a calming down of rates. I think people are just so concerned about where rates are going to keep going up. So everyone's kind of this wait and hold. Now things have kind of stabilized. I think the markets will come back a little bit, especially in the RMBS space. I'm certainly hopeful. Again, we're approved by S&P, Moody's, Fitch, DBRS, and Kroll. So we do rated deals for securitizations, and we see a lot more securitization activity starting to pick up right now, which I think is proof that people are kind of going back in the market again.
RMBS, residential mortgage-backed security market, activity on that market, ultimately what drives the interest rates everybody sees on their rate sheets on a daily basis. Rob, any other general just observations about the market, secondary market in general, as we get into the heart of a new year here?
Not really.
That's a fascinating insight. Yeah, thanks.
That's why I make the big bucks. I always find it funny when you're in a panel discussion or some kind of question, something like this, and you say, Rob, do you have anything to add? And the person inevitably says, no, not really, then proceeds to talk for 5 or 10 minutes about, even though they said not really. Mm-hmm. So I think every once in a while, in the past, there's been a claim, the secondary markets are frozen. Non-QM markets are frozen. Private label security markets are frozen. MBS, you're not going to be able to sell MBS, and the market is dysfunctional. I'd say over time, the MBS market has been remarkably well behaved, and there's some ups and downs and so forth, and those things make life interesting. But overall, I think the market is functioning very well. I haven't heard too many complaints about it. Fannie Mae and Freddie Mac are doing their things. The investment banks are doing their things. The buyers are out there. The volumes are way down. So the Fed doesn't have to be out there buying mortgage-backed securities. It really hasn't impacted the price too much, I would say, because volumes are down so much, and private investors like insurance companies and pension funds continue to buy mortgages. And I haven't heard too much in the way of dysfunction.
And Jim, and part of that though is because, and you're right at the heart of this, what you guys are doing on the fulfillment and the QC and the diligence space is the quality and the caliber of American mortgage loans right now is about as good as it's ever been. Employment, which is the biggest by far portender to default, is great. You've got delinquencies that are at all-time low levels. Fraud is at all-time low levels. You get great companies like Maxwell that have quality embedded throughout the process. So if you're an investor out there, a hedge fund, or anybody that's looking to spend money on any investment, you could buy a treasury with no risk at whatever the hell it is right now. But right now, man, I'm looking at mortgage-backed securities as a hell of an investment. You have prepay risk, obviously, but even just a little relief to where we're at right now on rates, I think would eliminate a lot of that. And that could help lead to a healthier than expected 23. No, Jim?
Yeah, I'm a CMB, I'm a certified mortgage banker, and I'm involved a lot in the CMB society. And we talk a lot about the subprime crisis versus the COVID crisis and what we learned from that. And to your point, Rich, the quality of loans, and the toxic loans, all the kind of stuff we've had in our past, and the CFPB and a lot of things that happen around the better quality of loans is proven well for us. The quality of loans, the default rates have been very, very, very low compared to what it could have been. The quality of loans that we see coming through on a day in, day out basis is just phenomenal. It's just, it's very, very low risk loans nowadays. Even the non-QM loans, which a lot of people go down the subprime route, they're not subprime loans. They're not conforming, but they're sure not subprime, and they're performing well too. So, the market is healthy. I think the quality of loans in the marketplace are healthy or are low risk. The oversight and scrutiny on quality is massive. We do quality control as well, the mandatory minimum 10% sample selection as well, but people take it super serious. They do portfolio loans, they're doing QC, 100% QC in their own portfolio loans as well, just because they want to make sure they have quality loans. And yeah, it's actually refreshing to see the quality of the marketplace very, very good right now. So I think we're in a good place, as long as there's a market to sell it, and loans out there for affordable loans for interest rates for people, or good quality loans anyway. And of course, Maxwell's involvement is there obviously to make sure that happens, right? I mean, from taking in the data exchange and all the way to the fulfillment to the QC to the due diligence. There's a lot of people, independent people, looking at it, make sure it's done correctly.
And that's the beauty of what you guys are bringing to market, from point of sale, from the borrower making application to the quality of the loan to the execution of it in the secondary market. I've seen so many of our members over the course of these last 18 months just speak to the value of that, and what a pleasurable experience it's been, working with you guys as a partner in that space. So keep up the good work. Exciting to see you guys continuing to innovate, and really, really appreciate the awesome insight. Especially on the MSR market. I've been doing this show for years now. We start talking about servicing, the numbers start just usually plummeting. But they were rock solid. Nobody fell off. And then that tells you it's a very, very interesting topic. And how Wells is tied into that as well. So
Rich, I don't cut yourself short, Rich. I think a lot of viewers, listeners are keenly interested in you having Christmas decorations that are still up. So I think that may have had a hand in keeping attendance up.
No airport parking lot reference, Rob. Come on, you got to keep the streak going. You're going after Cal Ripken here. We got some reader mail actually on that. It was, Dear Rob and Rich, what is Rob's obsession with airport parking lots? I've been flying my whole life and have never not been in a parking garage. Is there something I'm missing?
So I don't know what to tell you about the airport. I haven't been in an airport, fortunately, for a while. So I don't know what the parking lots are like, but I know the restaurants are still good. The employment picture is still good. I just see a lot of unnecessary
signs. Is that your backyard
signs
there, Rob? Or is this, and you hear what happened with Alex Rodriguez? Is this a stunt like Alex Rodriguez, the picture in the driveway in Minnesota with the snow shovel?
So this is a first world problem. And Jim, I'm sorry to drag you through this, Jim. But this happened right before the show, and in this little place in Truckee, you can see it's all snow, and there's a hot tub cover, and the hot tub cover, a little tiny hot tub on a little tiny deck, this little tiny house, and because of the storm, the wind blew the hot tub cover off and down the hill, and so before the show, I had to go plunging a broom handle into the snow to try to find where the hot tub cover wound up. And the hot tub cover, you look at it, you think, oh, big deal. Well, it's a 4 foot by 8 foot piece of plexiglass, which I had to haul up and put it back on the hot tub. And it's such a first world problem to have, Rich.
Are you going to be recognized for that with the Damar Hamlin first responders, Rob?
We haven't even talked about Lisa, Presley, Lisa Marie Presley. How's that?
What did she pass away? I missed that.
Yeah. I got to watch the news once in a while, buddy.
Somebody sent me a note saying she'd be alive if she were a football player.
Yeah, what team does she play on? She's that.
Yeah, she'd be alive if she were a football player. Anyway,
best place in the world to have a heart attack, NFL field, really, and that's not, think about that. That was amazing when it happened.
He's been released right from the hospital.
Yeah. He's back home now.
Jim, any parting thoughts for us before we take it into the weekend?
No, I just enjoyed being part of this, guys. I really appreciate the opportunity, and I think it's great topics. It's been an incredible week this week with the Wells news and MSR trades going on, and rates dipping a little bit. Let's see what next week has in store for us, because it's been pretty exciting this week.
Here's something we have actual volume. I mean, we spent the bulk of this year really talking about the Fed and inflation, because it's, he largely had the industry on the sideline kind of waiting for what's going to happen next with that. So here's hoping in 23, much more relevant business issues and topics to talk about, but we'll see. One thing about the mortgage industry, you never know. Wherever you think it's going somewhere else.
Exactly.
All right.
God laughs at those who make plans.
To our viewers, listeners, thank you as always for wrapping the week up with us. We're here every Friday at 3 p.m. Eastern. Rundown with Rob and Rich. Find us on YouTube after the fact and on podcast where most of you listen. Until next Friday, have a great weekend, everyone. Take care. Bye, guys.